Let's see. Okay, I think we're good. So this is the January 26th Edge demo. Good to see everybody. I want to start with it. It's on my mind. That's all. So I'm going to begin with this. But we could go. I'm going to go through volatility and liquidity second after this one thing, and then ideas. And I've said in the last couple of market desk notes we would talk about the conditions and how to know what those conditions are telling you, and we'll do that. But this first thing, let me see if I can find this really quickly. Is this, I've written a couple of things about these SEC rules, and I'm not gonna talk a bunch about the rules. I just want to show you something. That there's the say. I don't know who came up with it. The saying that a picture is worth 1,000 words. I would say in this case that a picture is worth about 1,650 SEC pages. So I'm going to show you this. So the SEC, for those who don't know, the SEC has proposed a bunch of rules. And already the market is highly complicated. It is governed effectively by 1,000 pages of rules. There are the 523 or 24 pages of regulation national market system, which is why Edge exists, by the way. My entire career in this profession effectively is predicated on the math of regulation national market system. I mean, I started before that in the investor relations profession, but these rules are what make the math of Edge possible. If it was an actual free market, it wouldn't really be possible to do what we do. But because the math regulates how trades execute, we can use that to our advantage. It's what enables us to see supply and demand. And so the SEC has now proposed these rules really in response to the difficulty that retail traders have had. We small guys, a lot of folks have experienced a lot of losses. And so the SEC proposed these rules to say, well, the little guy needs to have a better deal. I'm telling you, from a trading standpoint, and look, I'm a fan of the market that we have because it works for us as traders. I am not a fan of the market that we have from the standpoint of public companies and long-term investors because I don't think it serves their interests. I think companies should not be public today generally because it's not an efficient market for capital formation. But the SEC has said we want narrower spreads. We want quotes to be in tenths of pennies now. And I want to show you this image because I can show you exactly what the SEC is trying to do. And you will see it yourself this way. So this is I bought 198 shares of SHOP today. So we'll come around to those things. I don't know if it's going to work out. I mean, the math is still good, and we'll talk about that. But here's the key. Look at the price on the right. These two trades followed each other. As you know, I like to trade at the market. There was a penny spread in SHOP. Let me just let this person in. Hang on, Greg. Bring Greg in. Okay, Greg, you're just in time. You didn't miss anything. So notice the average price per share of my trade for 99 shares was $47 and 29 cents and 62 hundredths of a penny. So somebody crossed the spread for 38 hundredths of a penny. A machine did that between 28 and 29. It was 47.28, 47.29. That's why I do a marketable trade, right? Why would I put in a limit order? Why would I do it? There's a penny spread. I'm going to put in 99 shares, one less than the minimum quote currently. You have to, if you're a market maker, and you register as a market maker, you must make a two-sided market, a bid and an offer at 100 shares. If you don't actually want to match trades, you spread them, right? If you do, you narrow it. If you're willing to buy or sell, you narrow the spread. Well, what is that time frame? A day or less. And that's how Citadel made $16 billion. They made $16 billion, 38 hundredths of a penny at a time. That's the thing. Both of these trades were for tenths or hundredths of a penny. Where did they trade? in the dark. See that? So Interactive Brokers, I paid them $1 commission for each of those. It's okay. I don't mind because I get to see this information. I want to know where I trade. And this is the whole essence of those 1,650 pages. The exchanges, the NYSE and the NASDAQ and the SIBO and all the rest of them, there are 4 big groups and then a smattering of 4 or 5 independents, and there are 16 different stock exchange platforms. The NYSE operates 5, the NASDAQ 3, SIBO 4. Who am I missing? There's another big one in there. But this is the whole deal. It's because these trades occurred in the dark, which simply means they executed in an alternative trading system operated by a broker. And the probability is that it was Credit Suisse, UBS, or somebody else. Those are the big 3. Somebody else. But they just operate them, and a high frequency trader like Hudson River Trading came in there and took 38 hundredths of a penny on one side, and whatever the spread is on that side, let's call it 4 hundredths or 40 hundredths, 4/10 of a penny to match that trade. And that's it. And the exchanges want that to occur on their platforms. And they have sued the SEC over and over and over whenever the SEC has tried to change rules in a way that might actually improve the market. So this time they just threw in the towel and said, okay, we'll try to move all these trades onto the exchange. And by the way, if I start seeing my trades like happened yesterday, executing at the exchanges, I know I need to be out because the worst last prices are at the exchanges. I'm going to get much better deals here. You know, I had a trade below this that was 99 shares and it broke into 3 trades. One of those was for 1 share at IEX. So that, you know, you say, well, why does all that stuff matter? Well, I don't think it matters for you and I. We get a great deal. We do not need narrower spreads. We get great deals if you understand the rules. You cannot have a better trading market than we have. But is it good for public companies? Terrible. Is it good for stock pickers? Terrible. It's great for short horizons. I just want you to know that. Okay. So, questions, comments before we move on from that. I mean, it's almost nobody, you know, talks about it because they don't understand it.
You're right.
I don't know if you caught, you know, Thomas Petterfee, who's the founder of Interactive Brokers. He's probably close to 80. Still just a very, you know, vital fella. He's Hungarian. Immigrated to the United States and created electronic trading. He was the first guy to do it. He created a company called Timber Hill that Citigroup bought. This was a long time ago, before he started Interactive Brokers. And he knows more about market structure than perhaps anybody on the planet. And I know a lot about it. You know, there are a handful of people who know the amount that we do about this. There aren't very many. And he was on Squawk Box last Friday, and he said, I just got through wading through these 4 proposals by the SEC, and I can tell you it will hollow out the market. He said, I can make a case that it would be helpful to Interactive Brokers. But if you try to force prices toward the midpoint and put them on the exchanges in quote-intensive pennies, it will hollow out the market. No one will want to buy or sell. I mean, if there's no opportunity for profit, nobody's going to do it. And there's the good news, bad news scenario. You know, the bad news is Citadel took $16 billion from somebody because they're intermediaries, right? They're in the market purely to buy and sell from you and me. They're not there to create, you know, to form capital, to invest money in long-term enterprises that invent technologies and improve society and make markets more efficient and make life more interesting and comfortable for all of us. They're not in that business. They're in the business of being a middleman for tenths and hundredths of pennies. And that is permitted by, not only permitted by the SEC, encouraged by it, and now they want to go institutionalize it. But what does that mean? Somebody will always buy our 99 share trade, right? I don't want that to become 10 shares. Then I got to do 10 times as much as I did before. And this is where it's headed. I'm opposed to that. So now you know, right? Now you know the truth. The truth is the SEC doesn't want to get sued again by the exchanges, so it's going to try to shift some portion of that, almost half of all trades that's occurring in the dark. 9 out of 10 of my trades will occur at a dark pool. So 1/10 of my trades are going to the exchanges, and they don't think that that's fair. They want it on the exchanges. And so the SEC will help them. That's it. That's the truth of the matter. Okay, let's see. Are there questions? Let me get to that. No. Okay. Let's get to the meat of the matter. So one of you, and I don't know if you're here, but you said, explain volatility. You said you trade volatility, and you said it's the intraday volatility. And I thought the data on Edge was just delay date. It's 1 day behind, which is how I want it. I don't want immediate data because at the tick level, correlations are zero. You can learn absolutely nothing about price direction real time because somebody who is just after a 10th or 100th of a penny is the one setting that price. You cannot use that as valuable directional information. That is the truth. So how would we have current information? Well, I've got coin up here. I sold it today. Had I not been, I was out skiing. Had I been paying attention, it was a late night. We were out watching a jazz band with some friends at the press here in Steamboat. And I like to be in bed, by 9 because I have to get up early. And we weren't. And so I was, I'd raced out the door, skied, and I didn't check. And so I could have made $3 a share more on coin, but I sold it. So I want to go look at the volatility. It's an average, and I don't think you have to. This user said, "Well, I think I've got this tool that will tell me about what volatility is," and that's too complicated. You don't have to know that. It's very very simple. And here's why I sold it. So you notice this is still a big deficit on the supply side. Demand, supply, price. Demand very strong, supply falling. What will price do? Rise. And if it falls and these conditions have not changed, there is opportunity. That is telling us it could go up, right? Which it did. So I made my 3% on it. That's what I'm after. It could be more. There are broad conditions that are changing, but that little uptick for me, that's enough of a reason for me to leave. It's still fine? Sure. I mean, I'm not particularly concerned about it, but I might as well go find something else. Now let's go look at the volatility. This is what I mean as a signal about what to do. So I'm going to look at the portfolios. That it's not great, but I know it's in crypto stocks, financials, and it should be, unless it moved out of it, should be in the momentum port. Maybe it left. It could be because supply side ticked up. So we'll go look here. So I created this one, by the way. If you say, well, where's that portfolio? It's one I created. We've on the other business, we've got a couple of these as customers who use our data. What's going on there? If that happens to you, by the way, if you hang like that, it's probably Microsoft Azure, which is where this is hosted. Doing it, just hit Control R and it'll refresh and reload. Should be good, but they've had some problems the last couple of days. So I put these, if you want to take a screenshot of that, those are the things that I track in the crypto group. You may have others. It just gives you an idea. By the way, if you like to trade Bitcoin, I don't. I've never owned any cryptocurrency, but if you do, here's how do you know what to do. I mean, when these stocks when the supply demand diverges and you see this happen, you got a bunch of them at 10, probably you can buy Bitcoin. And once that deteriorates, get out. It's a great proxy for that, by the way. So here's coin. See this? Here's volatility. This is a 5-day read on the average spread between the low intraday and the high intraday. It's a great read on volatility. Beta is a terrible read on volatility. It's like measuring how a boat moves relative to the ocean. A small boat will be more will bouncier on the ocean than a large boat, but they're all on the ocean. It's much better to understand how prices move. And so, if I'm buying or selling Coinbase, if it's down 3 or 4% and supply and demand are really strong and diverging, all other things being equal, they're not reporting results. I'm going to look at broad sentiment. I'm going to be aware whether options are expiring. That's a particularly important thing to me because it's cost me money. I'm going to buy that, right? Because the odds are very high that it could. Now, the risk is it could go down 7% or more. It could, this is taking an average, but this is a very good read on how much price moves. And if we know supply and demand are favorable and it's down 3.5%, there's a very high mathematical probability that it will at least mean revert, if not go up. Well, then I've got a chance of making 2, 3, 4, 7%, right? So Shopify, which we'll talk about, that's exactly what Shopify did, right? If we go look at that. But does that make sense? Do you understand? I don't think you have to be too now, Steve Hicks. You apply some nuances to that that have been very effective for you. I don't think about it more than that. I will look at the things. I bought all 4 things that were in the momentum portfolio yesterday that I thought were good. Well, I bought Shop the day before, and then I bought Marvell, so MRVL. I bought Coin, and what was the other one? Gets away from me at the moment. Whatever the other one was. So I just do that, right? They were all down some, and it was just terrific because you're using this volatility and divergent supply and demand. We know that broad sentiment is top, but we're not in options expirations. We are in earnings, so I make sure I'm not, stepping into a black hole there. But you have a very good sense that as the market tops and begins to decline, that these things that are still at 10 can continue to deliver gains. And so they all did. I'm now out of all of them, and they were all just. I will say I had my best dollar trading day ever yesterday, just buying and selling those things. And that's not what I care about. I just want to get the 2 or 3%. But that's really what it comes down to: strong demand, 10, falling supply. Look at the intraday volatility. Is it down 2, 3%? Boy, I'm buying that. Even at times, even with these momentum ones, I might step in a little earlier. It doesn't work quite as well, but that is a terrific way to use that data. Comments, questions?
Tim, Gary Morris, you have a question.
Gary, good to see you.
How you doing?
Well, how are you?
I am fantastic, thank you. The volatility percentage, when I do a search for an individual security, I don't see it. I have to go back to the portfolio to pick that up. Is there a way on an individual search to see that number?
Alas, no. And I asked, the guy who built this, Corey, I said, should we do that? He said, well, we can, but it becomes duplicative in the logic. So he said, is there anything that we could improve other than doing this? So it takes you one more step, and I apologize for that, but I couldn't come up with a good argument to do that. So that is why. Why.
Thank you.
Yeah, you betcha. Okay, so let me go to Shop. This is what I wanted to do to just illustrate. Look, it's been a great trade. So if you just imagine that this is not here, that this data is here, so we only have this. Maybe even this. So we look at it here and we say demand is topped, supply has fallen off the cliff. You would say, so mathematically, this is, it's like the rest that is to come is unseen. We don't know what's going to happen. We know demand has come off of a peak, but it has stopped falling, and it's diverging. That's the whole thing. The whole thing is the spread between demand and supply. And I look at that and say, well, that is terrific. So now let's go look at the volatility. And I think liquidity is very important too. It's how much does a stock trade? I think it's the spreads can widen suddenly on you when you go to sell a stock if it's not very liquid. It's unlikely to happen if they're liquid. So then you come over here and there's Shop right in the middle here. Volatilities, of course, it's been skewed by what happened the last couple of days, but 8%. So if it's down as it was down 4%. And I thought, wow, that is an opportunity, right? So, but you have to, what are you doing? You're effectively trusting the math. You're saying, okay, well, I cannot see what's coming and the price is down 4%. What if it goes down 10? Well, you look at the math and you say, well, mathematically, it's not going to do that. I mean, again, options expirations can change that. Earnings can change that. Clearly, macro events that are unexpected could change that. But all other things being equal, that is a very good opportunity. So that's that, and it continues to be there. That's why I bought it today. Again, it might not work to my advantage, but I'm certainly not concerned if demand is at 10 and supply is down the last couple of days. The Hicks rule is when stocks hit 10 and the supply side drops day over day, that is probably a great opportunity. And it did that. Yesterday it was 10 and up. Up just means that it just got there. Like Splunk is at 9 and up. It's still rising. But that to me is very important. And then liquidity is this. There are a variety of ways to think about liquidity. I believe that this is the best way. And it's backed by, almost 20 years of looking at this data for public companies. And, a small cap company, it says, well, why won't our stock rise? We execute on a business plan and, we're doing everything we can and the stock doesn't go up. And I will look at their liquidity and it'll be $900 per trade. And I'll say, well, there's your answer. I will promise you that an investor like Fidelity or T. Rowe Price cannot possibly build a position in your stock at $900 a trade. It is not economical at all. They might put you in a giant basket that just, like Barry Bailey, you said, I bought $1,000 of everything in the momentum portfolio. Well, that's what they'll do. They'll just find a whole bunch of tiny little stocks and buy $1,000 of them. But that's the only exposure large institutions are going to have to stocks that they can't get in and out of. I know this stuff. State Street uses our data for portfolio management. And this is stuff we tell them, like be aware of the volatility and the liquidity and the strength. If you have to sell stuff because somebody has changed the portfolio manager, they've decided that instead of using Neuberger Berman, they're going to use Barron funds, then all the stuff that Neuberger Berman owns gets sold, and all the stuff that Barron funds owns gets bought, right? And that has to be done. And believe it or not, firms like State Street don't think about the stuff that we're thinking about. We've opened their eyes to that look at this. If there's, move the stuff that is liquid and easy first. I mean, you're going to improve your economics. And so it's how we use this data. I mean, if you looked at, let's just take an example. TeraWolf, which is this is a customer on the over at Modern IR. Well, look at what they trade, $400 a trade. Their volatility is off the chart, but the spread will be astronomical. Very difficult to make money in that. And so it's just, I think those are very important things to understand about how the market works. Okay, comments, questions?
Jim, what's the bottom line on the trade dollars then?
Well, I think so. So we internally, these system portfolios that we create for you, like momentum and low volatility, the cutoff is $3,000 because that's where the Russell 1000 is. You can go look. So if you say, well, I didn't find all the diverging supply demand trades here in the momentum portfolio, it's because the cutoff is $3,000. And that because those consistently, not always, but they consistently will have a lower spread of, say, 10 or fewer cents. I was trading, let me think about this. Was it Schlumberger, MetLife, two positions I had earlier this week, and there were times spreads of about 15 cents in those stocks, and they're giant stocks, but their dollars per trade are north of $3,000 a trade, and so they tend to narrow, and that's what the cutoff is to me, Raven, about $3,000.
Thank you.
You betcha. And there was another question. Barry, was that you? I couldn't quite catch it. No? Okay.
Wasn't me, but I do have a question.
Okay, fire away.
So Microsoft volatility is 2.7. It's up 2.4, but demand is dropping and supply is at 58.8.
Okay.
So at some point it's an interesting one to watch. At some point the math is going to have to work.
I absolutely agree with you. And I'll show you that. I'll follow that with a little data. I agree. You look at that stock's going to go down. So if you're short it, you look at that and say, mathematically, there is nearly, not absolutely, but nearly a 100% chance that price will be lower than it was before this. So if the price was, let's call it 240 here, what is the mathematical probability that in the next 5 days it will be below 240? Very high, right? Very high. Again, I'm not saying it will, but this data, this is what Barry's talking about. I mean, it's 59% short, and that is rising way over trend, and supply is falling. The likelihood that it holds its gains is very, very low. It may persist for 2, 3, 4 days, but there will be a consequence, action and reaction, cause effect. That is how market structure works. The reason the price went up here is because supply was low in here. That is why. Now those conditions are reversed. I'm right with you, Barry. I think you're absolutely correct about that.
It's going to be fun to watch.
Yeah. And the data point that I was going to use to follow that, I just do this for fun. I don't short stocks. I know you do, Barry, but because I'm not good enough. I'm going to start. Look. I want to hedge too. There's no question. I see we're having some caching issues, which is, in the technical jargon, this would be Redis and Kubernetes. I know just enough to be dangerous about what the programmers do, and I think Microsoft is having some issues with those. So they're slow to load. See that? But that's what it is. Not our system. They're the ones providing the transport here. So here's it. So I don't short stocks. I'd like to have a hedge. I was going to say Jane Street does this. Very successful trader. They're well known for having baskets of puts, little baskets of puts as a hedge. I don't have a hedge, and I could probably improve outcomes by doing that. But look at this. So here's a short portfolio that's looking for these particular conditions: falling demand, rising supply. Exactly, Barry, what you see in Microsoft. And there are 120 in it. Back up 5 days, there were 4. So clearly the market is about to tip over. I'm not saying it's going to be bad, but it could be. This also had like 4 or 5, and they're just slightly different data. If you want, I'll show you what those are, but it produces that. I'm just doing some research. And this had 4, now it's got 152. Industrials, passive money. Passive money is short a bunch of the market now. That will be quants. But you look at both of these, industrials leads. That's interesting. That's an economic play, right? So that global macro money looking at consuming economic data believes industrials are in trouble. I'm not saying that they're going to be, but it's an interesting read, right? You can know that just by looking at the data. You don't have to read anything. Just do that. So this portfolio, all I did, it's very simple criteria, was this. So if you want a screenshot of that, again, I'm not saying it will give you everything you need. Raven, there's that liquidity. 3,000 more. I like liquid stuff. And the market structure sentiment is down as 7 or less. So it's trending down. Supply is greater or equal to 50% and rising. So all I'm looking for is liquid stocks that have converging supply and demand, which produces falling prices. So could be, and then what do you do with that? Well, if the going back to the portfolio, oops, sometimes that works, sometimes it doesn't. There, you could sort them, right? You could sort by supply. Say, give me the worst, but. So FND is 7 and 85% short. It's a consumer discretionary stock. I'm not saying that it's going to go down, but hedge funds are shorting that. How do I know? Because active money is leading and it's 85% short. The only behavior that can be is hedge funds. So they may be right, they may be wrong, but it's interesting. You know, it's again, there are all kinds of things you can do with Edge, and I don't do this, but it's interesting. It's interesting to see. Okay, let's finish with here's where we are. So if I begin the day, I'm using these things. The first thing I do is check the number in each of these. This is starting to rise. This is clearly plateaued. I think momentum those trades have continued to work, but I think the market is about to lose its momentum, and I think where the money's going to go is here. So realize that it's difficult to anticipate where the puck is going in the market, but that's what the data show. And just look across your dashboard. Look, all the demand trends are coming down. Everything that you look at, communication services trailing off, supply side's fine, but all the demand sides are coming down. That suggests to me that the market doesn't just tip over. I've said, if you're going to have a bad day, it's right around the last few days, and we didn't. But at some point, this is going to produce a decline. If the supply side falls at the same time, it tends to be slower developing. But you could look across every single thing nearly. I'm going to change this to big tech because there aren't FANGs anymore, right? But those have been really good, but it's peaked. So if you're in big tech, this is a great reason probably to not be in big tech now. Take gains, not chances, right? So then look at broad sentiment. What's it doing? Well, we're past expirations. That was the peak. And the market was very volatile during expirations. And now demand's coming down and supply is rising. What's the probability? Well, mathematically, there's a 100% probability that the market declines. It may not be linear. It could be very much like November. This was a long time developing, but the very same thing happened at expirations in November. And there was a big supply deficit. The market did very well. It was even higher over here. But once these conditions begin to deteriorate, the market will decline. And then when it dropped below the green line, we could say there was a 100% probability that the market would rise. Not linear. I don't try to predict when it's going to happen, but I know that rising demand and falling supply will produce strong stock performance. And oftentimes, if passive investment is the lead behavior, it is going to go into the things that they're underweight and that have declined the most. Well, what was? Tech. Tech did great. Don't read into tech a recovery in the market. It was merely the behavior of passive money. Money comes into the market in the new year. We have to do it too. We have a 401k profit sharing plan. We have to put big chunks of money to work according to those rules. And there are certain times when those things occur. Well, everybody's got that stuff. In the money comes, there's a 30% allocation to equities. What equities will they go into? The ones that everybody's underweight. Tech goes up. All the pundits think, oh, we've got a recovery in the market. The economy's looking great. No, it's not. This is just market mechanics. So I think the market faces trouble again, but we will be fine with Edge. There are great things to trade. Supply and demand always work. There are times to be in low volatility, times to be in momentum. I figure we're going to shift to a more low volatility kind of environment, but the Hicks rule works. Take your 2%, right? So that's all I've got. Any questions, concluding comments?
Do you think some of the broad sentiment movement that you're seeing right now is in conjunction with the Fed speaking next week?
Could be. Could be. That global macro money. But again, if you looked at if you use those short portfolios as a read on global macro money, the global macro money thinks the economy is going to deteriorate. We already would say that those things are in place, but yes, certainly. And there's speculation around that. People bet on it, just like around earnings. Yes. Yep. What do you think?
Oh, I think it's going to drop big time.
I think we are going to at some point have a sudden bad day again. Yeah, and the failure of the NYSE's mechanism for mega caps, that was bad. It's not getting the proper credit it should. That was a disaster. That could torpedo the market. I mean, it's just that's the stuff that keeps me up. It's because the market is software, and I'm in the software business, 2 software firms. and you have one bit of code that isn't right, and the market hinges on those things, and it doesn't take much. Other than that, everything's fine. You know, you know that line that you, Steve, will remember this, but this goes a long way back, and then I'll wrap up with this. That line I learned from a British friend of mine, a college classmate, and he introduced me to Faulty Towers, which was a British television program starring John Cleese, who was part of the Monty Python troupe. Right. And there's a particular episode of Faulty Towers where he runs a restaurant in this apartment building, and the health inspector comes and just reads him the riot act. I mean, there was like, cockroaches in the kitchen. There was a cigarette butt in the ice maker, and they were all this long line of things that were wrong. And it gets, the health inspector reads him the riot act and finishes. And then John Cleese pauses, and then he says, but other than that, everything's fine. So I've used that line ever since. I will say, well, other than that, everything's fine. Anyway, good to see everybody. Have an excellent weekend, and I will catch you next Thursday. Look forward to it.